I'm going to go call the meeting to order. I'll go ahead and start. We have an agenda before us. I'd be very happy to accept a motion to approve the agenda as presented. Do I have a second? Second. All in favor, please say aye. 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 We have an agenda. We have the minutes from our last meeting. Do I have a second?
Roll call.
I'll get it.
Second.
Thank you. All in favor of accepting the minutes from the last meeting, please say aye. Aye. All right, we're going to go with roll call. Slight adjustment to the agenda. John Fisher, member.
David Rader, member.
Ross Johnson, Principal U.S. Property Account.
Greg Pittenger, Principal Asset Management.
Tommy Lewis, member.
Matt Barker, member.
Greg Williams, staff.
William Johnston, staff.
Brendan Vavrika, Anco Consulting.
Fantastic. Oh, we have our, oh, anyone else online?
Yeah.
Greg?
That's there.
He's on music.
And
We know what he said.
All right.
just for informational purposes.
There we go. Thank you.
I spoke with the clerk's office, and you know how in the past, because of the COVID, we had sort of a waiver of attendance for extraordinary circumstances. That's really no longer in effect. So Pat is welcome to join us via Zoom and participate in discussions, but he's not able to make motions or vote on anything, just to clarify for the
All right. When was that change?
sometime last year.
Okay. Okay. We'll talk about parking at the end of the meeting, so on a separate agenda. So thank you for those that do show up here. All right. We have our friends from Principal. Gentlemen, the floor is yours. As you know, we're a fairly interactive, inquisitive group, so if it's okay with you if we have questions during the presentation, we can kind of
We'd love it.
banter back and forth. That'd be great.
The more interaction, the better. Excellent. Well, thank you all. You all have your books, I think, in front of you. Again, my name is Greg Pittenger. Yes. With Principal Asset Management, I serve as your client advisor. I mentioned earlier, I'm based out of Raleigh, North Carolina, and work with institutional investors like yourselves all throughout the Southeast. Fortunate today, we're going to be focusing on our real estate platform, which you folks are invested with us in our core real estate fund. I'll turn your attention briefly to page 4 and give you a kind of an overview of Principal Real Estate, and then we'll walk through the fund-specific information with my colleague Ross Johnson here, who's a member of the portfolio management team. So page 4, as you'll see, throughout COVID, as you mentioned earlier, William, we've been growing on Principal Real Estate. We manage just under $100 billion in assets under management. This is as of 12/31, a top 10 global real estate manager. So we've been growing throughout the real estate platform. We have over 300 employees focused just on real estate in the various areas I'll get into in a minute, with about 13 years, a little over 13 years of average experience. So a very tenured team in good hands, seen multiple cycles, both good and bad, as we're seeing some volatility right now. Today we're going to focus on that top left quadrant, if you will. It's private equity, the core focus, about $50 billion, so half of the assets under management. As you'll see, that's the lion's share. It gets the resources that needed to affect everything on your behalf as clients. One thing I would add on this piece that we've talked about briefly in the past is we call this our 4 quadrants. And I think this differentiates us a little bit from some of the other folks you might work with, in the sense that Ross and his team have access to both not only the private equity analysts and everybody else on the ground for real estate, but also on the public space, so in the REIT space, as well as in the private debt and public debt markets. And at times like this, where you see a lot of stress in the debt space, it's very important for Ross and his team to have access to internal folks to really, kick the tires as to, is a debt deal going to get done? Is this realistic in the marketplace? What's happening specifically in Tampa, where you might be doing things, or versus Denver versus Phoenix? We have folks on the ground in each of those areas to really kick the tires and make sure that what we're trying to do on your behalf is effective and efficient. So with that, I won't spend any more time on the bullet points given the short amount of time we have today together, but if you have any questions on the real estate platform at all, I'm happy to answer them, and if not, we can move on to the fund.
Sure.
Thank you.
Just quickly to slide 6, introduce myself. I'm Ross Johnson, portfolio analyst for the U.S. Property Account. I've been on the team for 5 years now. Been with Principal for 11. Prior to my role on this team, I started on our private debt origination team, originating loans in the Midwest markets, Chicago and Dallas in particular. The rest of the team remains largely unchanged from what you've probably seen in the past. So Darren and Megan are co-portfolio heads. Megan joined the team in 06, Darren in 07, Bridget in 2013, myself in 18, and just added Ellen Bennett in 2021. And on slide 7 here, we have just a account summary of your guys' investment in the account since inception. So let us know if you have any questions there. Just provide that for your benefit. If we flip to slide 8, we just provided kind of an account profile snapshot as of the end of the year. Our gross assets were just about 13.3 billion, with net assets of 9.8 billion. The rest of these stats we'll touch on later in the deck, so I'll skip some of those, but I do want to talk about the contribution queue and withdrawal limitation there, the last 2 bullets. We continue to have a contribution queue in place as of the end of the year at $566 million. Of that, we do have a large client in the queue that for $500 million, so they take up the lion's share of that $566 million today. We continue to be in communication
You're
with them.
standing in line with 500 million, do you?
Yeah,
With your results?
they are.
Yeah.
Is it Calvers?
Yeah, and we continue to have communication with them, and they do intend to invest, and they've really asked us to advise them on what that right entry point is for them as values and volatility has been in the market. So understanding where that entry point is, and that's really how we've gone out to all new clients and consultants in the market. We think core real estate is going to have strong fundamentals going forward, just as things have reset. I think core is probably a good relative value option. So we've talked to them and said it's a great time to do due diligence, great time to do your documentation today. It's probably not a great time to invest right now, given some pressures, but from a long-term perspective, it's a good time to kind of get in line, so to speak. And then with the withdrawal queue, we ended the year at 15 million in the queue. Year to date, that's grown to a little over $1 billion, or about 11% of the account's NAV. If you compare that to the benchmark, at the end of the third quarter, the benchmark had aggregate redemption requests of about $23 billion. That escalated by the end of the year to $32 billion in aggregate redemptions across the whole benchmark. So that's a little over 12% of NAV for the benchmark. So on a relative basis, have fared well there.
Got a question on that.
Yeah.
So if you have the data, what dollar amount or percentage of that is a function of normal rebalancing, and how much of that is people making radical changes in their overall allocation? No, you know.
I don't think exact. So I know six clients in the queue are doing a full change to their plan infrastructure. The rest of them are just partial redemptions due to the rebalancing. So the majority of that is rebalancing.
I mean, I'll just throw that from my perspective. I would say 75 to 80% is just straight rebalancing, denominator effect. Because you had public markets decline while
Exactly.
privates through last year had been staying elevated.
Right.
And so you're out of balance, so you're looking for rebalancing.
Okay, thank you. Right.
Yeah, and historically we've only had 3 queues in the 40-year history of the fund, the GFC, COVID, and then now. And we've seen within those queues, by the time we start making redemptions, some clients end up rescinding their requests anyway, just because as equities or values have dropped, so now that the denominator effect is less of an impact for them. So it is likely we'll continue to have both of those queues just until we get some better clarity on the market today, just the overall macro environment, particularly given some of the bank failures today and that volatility. We need to continue to watch and understand the cash flows both in and out there. So any questions on the queues? I just want to touch on those.
Do you have I know it's market dependent, situation dependent, but do you have an idea of when you might start releasing some withdrawal funds?
It's tough. So when our team flipped the calendar probably in January, we felt better, like things would move and potentially maybe target end of the second quarter to start making a payment. Within the last couple weeks, that is feeling very different. So
Sure.
Yeah, hopefully we get some more clarity. But that outlook's probably changed a little bit.
Sure.
Okay. And if we flip to slide 9 here, this is just our strategic themes for the fund. So on the left-hand portion of the slide in the blue font, these are our high-level themes for how we look at investing and how we look at risk for the portfolio. Those high-level ideas or that framework really doesn't change over time. What does change is how we look at those sub-bullet points or how we attack those themes given the market environment. So 12 months ago, you probably would have had us talking about disciplined capital deployment as we look at acquisitions and the pipeline at the time. Now that's switched to being more defensive in nature, just given the potential for a recession here in the near term. And we've really rebalanced just how we're looking at risk-adjusted value today. We've always been very prudent on our liability management side of the balance sheet. We'll talk about that a little bit more later, but that's really been heightened just given interest rates today. And then finally, driving operations has been a key focus for us. Just really focusing on that property level operations and growing income. As rates have risen, as investor return requirements have gone up, the best way we can offset that, and the one tool we have in our control, is to grow income at the property. So we're very focused on that piece. And we'll talk more in detail on that forecast later today. Here on slide 10, I think it's just a good visual slide for how our investment decisions have materialized both regionally and then at the market level. So the size of the bubble here on the map represents how much on a dollar basis we have in those markets, and then the color of that bubble is whether we're over or underweight to the index. We work very closely with our in-house principal real estate research team to target which markets we think have long-term growth drivers. They've built out a framework they call, it's an acronym, digital, where they've focused on key demographic trends, innovation, technology drivers of growth, and then really how we work with that team kind of is materializing what you see here on the page. So we're overweight the West region and the South region, and those have been a strong relative performance when you look at the performance there relative to a Midwest or East region, particularly over the last couple of years since COVID, where these regions have been the net winners just from a migration perspective.
ODCE, what does that acronym stand for?
Oh, Odyssey, I'm sorry. So that the NFI Odyssey is our benchmark. So you can think of them as like the S&P 500.
Okay, yep. Okay, thank you.
And then over the next few slides, we've just kind of given you a high-level look at each of the major sectors we invest in, what our allocation was at the end of the year relative to the benchmark, and then how we look at each of those strategies from a sector level. So on 11, we'll start with industrial. We ended the year slightly overweight industrial to the benchmark. Within how we invest there, we'll look to maintain our overweight to what we've identified as major distribution hubs, which are in the pie charts there on the slide. We look to remain within warehouse and distribution product types within that sector. And then finally, we look to what we kind of talk about is owning the right product in the right market. So once we've kind of worked with research to identify a market that we want to be in, we'll then go to our production staff, so our acquisitions group and our asset management group, and really talk to them and understand within this market, where is the most tenant demand? Is it tenants that are 250,000 square feet, 500,000 square feet? And that's the deepest part of demand. And we probably need to target a building that's maybe a 1 million square foot building. Is the demands on the lower end of that spectrum? Maybe we need to target a building that suits those tenants and needs. So just focusing on that piece so that we maintain long-term pricing power in the market there. As going forward, we'll look to maintain that overweight within the industrial sector. If we flip to residential, this residential remains our highest conviction sector within the account, and that's evidenced by our overweight relative to the benchmark today. We've always targeted owning differentiated product within the portfolio, but also in residential, we've focused on having a diversified tenant base within it. So what I mean by that is highlighted by the pie chart here on the slide. So we own affordable workforce product in the portfolio. We have Class A, or what we call renter by choice product. But we've also diversified into student housing, age-restricted communities, manufactured housing, and then finally single-family rental portfolio. So we think having those unique tenant bases and the drivers behind those will provide strong performance across different market cycles, as all of those kind of can react differently at different times.
I'm just curious, how do you classify affordable kind of workforce housing? What does that mean?
Right, yeah, and everyone has a different definition of it. The way we've attacked it is more like a chunk rent. So targeting, when we go to those asset classes, and it differs slightly by market, but a rent check that's in the $1,800 to $2,200 range, call it. So, but still focusing on what's the median income within that range and what can people really afford in that area. So that's how we target. I know everyone kind of has their own definition of what that's called, but and then also we have a few product deals in New York City that have the affordable bands within it. So it's you have to have X amount of tenants within that 50% of AMI, and then you get a tax benefit from it there. So those are more bond-like because of that. There's massive waiting lists for that product within that market. So kind of the two ways we've attacked that affordable. And then if we flip to slide 13, office certainly remains the most challenged sector in the space for sure. I'm sure you've all seen news articles or anything since COVID with work from home. We've got our portfolio underweight the benchmark. We've done a lot of work to get to that point. We peaked at about 47% office in 2015, so we've sold down over $2.5 billion since that time to get to the underweight position. We're going to continue to look to reduce that where we can. The asset here on the page, 601 New Jersey in DC, is an asset we think has some relatively strong liquidity in the market today. AT&T is our largest tenant in that building. They actually just expanded and then extended their lease term, so we're over 98% leased there. We think that's a potential building we can bring to market later in the year, and it would actually have some investor demand there to provide some liquidity. So,
Before I got a question, again, looking at, I mean, your slight underweights and overweights, I mean, how driven are you guys to be tracking close to the index rather than just using what the best value is? Because it looks to me you're fairly close to the benchmark. So,
Yep.
I mean, how constrained are you to have to track the index versus not? So, I don't recall exactly how you structure it.
that's a great question. Our guidelines say we can be 50 to 150% of the index. So
Okay.
really the guidelines give us some wide variety to take
Okay.
a heavy overweight or heavy underweight position. So it gives us a good range there. How we've targeted that is that focus with our research groups. So where's the best long-term relative value? Where's our highest conviction? Within that space, that's where you'll see us take those heavy overweights or underweights. Within office, it's probably a little transitional now. We're trying to get to that more heavy underweight today, which is kind of what we've highlighted here in our strategic range. Does that help answer?
It does. So as an example, you have 50 to 150 range. Historically, when have you been the widest, I guess, variance from the index? I'm trying to get an idea of how usually you can do. What have you actually done? So I'm kind of curious.
Probably not going to give you the exact percentages. So in 2015-ish time period, our research group came to the team. This is prior to me being on the team, but they said multifamily apartments were the supply that was coming online just didn't make sense in some of the pricing at the time. So our team actually had a very strong underweight to the residential sector. I can't remember the exact percentage, but a lot of people were chasing apartments, and that was a very strong relative performance as apartments went on to underperform the index over the next, I'm going to forget how many calendar years there.
Many.
Another example of that is just from a regional perspective, we've been underweight to the Midwest region for a long time, given the performance there, particularly Chicago being the largest market. It's very hard to underwrite a deal in Chicago because you have no idea what the tax bill is going to be for year in, year out. So we've actually been further than that 50% less at times in the Midwest, because even though the guidelines say we have about 50 to 150, it also gives us the ability to say if there's no relative value or options to invest, we're not forced to do that. So it gives us a little bit of bandwidth there.
So here's another unfair question. So if in fact from a liquidity standpoint you were going to get completely hosed if you had sold properties, starting today, a better question. You need $100 million, $1 billion. How do you? I know it's very property specific, but for an allocation, what would be your idea today?
Today the two would be within residential, particularly within this pie chart on that slide, focusing probably within those kind of alternative property types we talked about, so building out that manufactured housing, single family rentals are two of the big ones.
Okay.
Industrial would be the other piece of that if we can find if the prices have reset for it. Certainly, and then actually we'll get to retail, but retail's been a very strong performer since COVID, particularly in the necessity-based space, so grocery or retail, so those would be the places where we looked out.
Okay.
Yeah.
And I think one other thing to point out in office, just to differentiate, you can see it's, I apologize, it's like size 8 font down at the bottom, but we focus in the growth markets. You'll see that 40%, kind of that royal blue again, versus the index that we talked about earlier, the Odyssey at 18%. So the gateway markets, the traditional markets, you think of Boston, LA, Chicago, New York, that have had a lot of difficulty, especially in the office space through COVID. We're underweighting specifically those areas and have regressively written down some of the valuations from our perspective because of mass transportation. People are not going back to the office. We don't say there's not long-term value there, but we're being realists and saying there's definitely difficulties here. We don't see this improving in the near term. So we've taken a pretty active write down on that space and not focusing on that area, obviously, even prior to that, I mean, I think Ross mentioned, going back to 2015, when we had 47% in office, that was an active overweight.
Yeah.
And we've actively sold off, well before COVID, large chunks of that, just because we saw office dynamics changing and seeing better opportunities, you mentioned, in multifamily or industrial over the last 6-7 years, prior to that. So.
Thank you, I appreciate that.
Yeah.
All right.
And then if we finally flip to retail here, we ended the year equal weight to the benchmark. However, how we built our retail portfolio, that mix is very different than the benchmark. So in the pie charts, you'll see we have a heavy weighting, almost 80% to what's called neighborhood or community centers, and really those are those necessity-based retail centers we talked about. So majority of those are grocery anchored centers in the portfolio. And then conversely, the benchmark with a third within that property type, and then the benchmark also has over 30% in the mall space, and we don't have any malls in the portfolio. We had never had malls and don't plan to be in that space anytime soon.
Pre-COVID, what was retail within the Odyssey? It's a lot larger than 10%, correct?
I want to say 15-ish,
yeah.
somewhere in that range, yeah. Which we were pretty close at that time too, and so with just write-downs in general, and then we've sold a couple deals here and there, just trying to track the index.
And just COVID with industrial and residential doing so well and growing, the retail and office and shrinking.
Yeah, you didn't have to really buy or sell, it just by virtue of everything else moving around.
I think a big point of this too is we focus on the really strong grocery anchor tenants like Publix down here in Florida, or where I'm in North Carolina, Harris Teeter, on the West Coast, maybe Bonds, for the bigger, strong markets for our strong grocery chain, if you will, in each of these centers. That's held up quite well.
So when you're selling property, I'm always curious the other side of the trade. So you're selling because you think you have better relative, and somebody else is coming in and looking, they're getting a relatively good deal, but you would think that. I know it's, again, it varies by property type, but who's buying it? These like dumb doctor groups? Is this larger REITs that have to deploy capital? I'm just kind of curious who's buying this stuff.
Today specifically, you mean?
Yeah.
So I think a good example is actually within office. We sold a deal that closed the start of 4Q in Houston, a large office tower there. We went to market on that deal. Had some, our largest tenant was in the oil space that had some potential credit issues there. It was a deal we wanted to get exposure out of. We went to the market, we pre-marketed that deal where we had the asset marketed at $180 million. We actually sold it to a group called Oak Tree Capital, I can't remember the exact name. And their focus is a high dividend product for their investors. So they target like a 6.5% yield to their investors, and we sold this office building at a 7.5 cap to them.
Okay.
So feels like a really high number. It was a deal that we wanted to be out of.
Right.
We had marked the asset, and we actually closed on that deal at $176 million at the end of the day. So it just goes to that's a group that out there was happy to targeting that yield product,
Sure,
but
okay.
also how we had marked our asset down. We didn't see a big difference in where we held the asset to where it actually traded in the market.
And I think prior to the last 6 months, where you saw the bond market obviously change a bit, and financing options, we would sell core properties that were well established and well stabilized to other core funds who are coming onto market that are new and just needed to put money to work, and we would rather build it. We had a much better dynamic where we could build industrial and multifamily for way cheaper than you could go buy an existing product in the marketplace. And
So
obviously the finance has changed a bit recently, but that was.
So you're selling to forced buyers in some respect.
Yes, that has changed, but yes.
So how does your history of sales price compare to your valuations?
Actually very strong. In different calendar years, it's been different. Probably the last 2 years when we've gone to market, we've actually outperformed in some cases by double-digit teens from where we've held assets. And now it's just as interest rates and investor frenzy over 2020 and 22. And then towards the end of that latter half of last year, we were right on target with where we had marked assets. We didn't have a lot of deals in the market there, but historically has a very strong track record there. And that just goes to our valuation process and the daily valuation of the funds.
Yeah, I think we'll get to that in a minute, but as I mentioned, I think yesterday, we're a bit more conservative than I think a lot of our peers in this space. And you'll see that both from making sure we take write-downs in office when we think it's prudent, even though there might not be a bunch of transactions on the marketplace. We'd rather be accurate and proactive in front of you guys than some surprise in the back end that as folks catch up and realities can hit some of these other folks in the near future, they're going to have a surprise that's unfortunate, and we don't want to bring that to you all as bad news.
So doing that, it seems like it it might increase your reporting volatility a little bit on returns, right? So you're marking down more aggressively, creating maybe slightly amplified negative returns, but then after that cycle, after you move sort of through that devaluation cycle, you have more room to mark up. So you're going to bring those returns back at some point.
Yeah. Well, and also just the marketability when we go to your clients, don't want to start that relationship with come in and then there's a potential just flat line or a reversal of those returns. So yeah, making sure we have that right.
And that's where, to your point, I think the price transparency, we want to make sure both on the front end and the back end as fiduciaries for everyone that's coming into the fund.
Sure.
So that's as accurate as possible.
We saw this a lot during when COVID first happened. There were a number of managers within the Odyssey, when they weren't collecting rent, they would just keep it as a receivable. So they were fully valuing all the rent that wasn't being paid, and some of the other managers were taking 100% write down. They were writing it all off, and then they said, okay, if and when that rent comes in later, then there'll be a boost. But it just kind of depended on perspective. Yes.
Yeah, we'd rather be transparent with you all as well. We don't want to surprise you. So I think that we've stuck consistently to that through the GFC, through COVID, through this transaction. We want to make sure we're being as upfront and as we realistically think, as Ross mentioned, the team has a realistic expectation of what we can do. Even if valuations might be from a third party a little inflated because there's no transactional activity, we'd rather make sure we're on the ground, we're seeing this and valuing it properly.
Yeah, and just given, Greg talked about our 4-quadrant approach too, just given the information we have in-house with kind of live discussions with our acquisitions group or the REIT group of where investors are and what their requirements are today, give us the ability to really reflect that real-time value. Whereas if some plot, we'll talk about later, relying on appraisals just tends to be a more lagged system and how that gets through the process there.
So you see your leverage ratio right on 24. How does that compare historically? I forget the exact your amount.
Historically, we've been probably in the last few years as low as 19%, and 24 is probably on the higher end of where we've been. Right. We will try to target bringing that down where we can, but in that 20 to 25 has not been huge.
Not just bond market financing. I think you've got a good chunk of maturities this year. So can you explain?
Absolutely, yeah. We can flip right to that. So on slide 17 here.
Before you go, stupid question.
No, I'm sure.
You got 1.3% in life science. What's life science?
So
define that.
Yeah, so you can think about those as like lab space. So as tenants are in there, drug companies, pharmaceutical companies, they utilize more of an office style building, but it's been built out specifically for labs. So there's ventilation systems in there. Yeah.
That just wasn't something I knew.
Yeah, so some folks put it under office, but to Ross's point, we have a lot of in Cambridge, Massachusetts, where you think of all the universities there and trying to do a lot of scientific work, obviously. So it's done quite well versus traditional office has suffered. That's a
We do a lot of drugs in our office.
So I've got kind of an off-the-wall question. It may not be fair, but the Sonoran Village that you've got a photo of there on the next page?
Yeah.
So what's rent on a 2-2?
Probably at 33,000 to 3,500, maybe even more than that. It's one of the higher rents. So that's
It looks like a premier, just,
Yeah, so we call it type 1 construction. So it's concrete podium construction there. Our partner, it's very nice product, and it's right in Scottsdale area, right by Camelback Mountain.
So is that young professionals?
Yes. Yep. And actually, when we toured this one a couple of years ago too, there's actually a couple of the NBA teams live there as well. So it's pretty high-end units. He had his chef in the unit next to him. He rented out 3 of them. His kids had one with their nanny. So yeah, it's very high-end product type there. High rent.
Can I get a room?
Just wondering. I was just wondering whether I could afford it.
We just went through our whole portfolio from the residential side too, and just looking at what's the median income of the renter and the tenant profile there. The median income, so not the average here, was over $260,000. So it's been a great performer. The location you can't replace, and the whole living wall you kind of see here. That was the city forces to have that in order to actually build the product there. So back to leverage. So on 17, you mentioned kind of the higher debt maturities there. Ideally, we looked at diversified over our schedule here. In 2023, we actually have already paid off one of the loans you see here on the slide. The remainder of the loans, the majority of those are floating rate debt on recent development projects. So deals that we built, we generally use floating rate debt on those. Now they've stabilized, we're at that kind of decision point of, do we want to go out to the market and look at more core price debt, fixed rate debt longer term? Or do we want to evaluate just paying those off and holding them free and clear now, just given the pricing in the market?
So where'd you get the capital to pay that off?
So that would be based on cash today. So that's where we're really having to balance the cash today and where our outlays are, and that's partly why we continue to have the withdrawal queue in play today. We do understand and we realize we're going to probably likely have to dollar cost average into some of this higher rate environment. We can't pay down all the debt, so we'll evaluate those as we come up. We have a team in-house that actually focuses on sourcing debt for all of the equity portfolios, so they have a line into all the different lender groups, and they're constantly getting pricing, so they help us with really assessing where's the best relative value. Is that putting debt at the property level, so just if we buy a deal or existing deal and we want to encumber that specific asset, or we want to put debt at the portfolio level, so there's a process we can go out and get debt at the fund level, and there's been times where that's really dislocated, where sometimes that portfolio level debt is much cheaper than putting it at the property level and vice versa, so they really help us evaluate that piece.
Thank you.
You said these are all floating rate?
Yeah, so the remainder of that matures.
It's left.
Yeah.
When did you acquire this debt? 5 years, 10 years, 6 years, 2 years?
So most of the construction is within the residential apartments space, and generally those are 12 to 24 month builds, so for the last 1 to 2 years.
Relatively recent.
You do any sensitivity analysis, so if you have to go with the higher floating rate debt service, how that's going to hit cap rates and different deals? Any, I'm just curious.
So as far as like within ours, or what if we can go replace?
Yeah, if you're going from 3.5% floated to 6.5, obviously the money's got to come somewhere.
Yep. And that's, it all kind of comes full circle a little bit with values today too. If you have a really low cap rate and you go to the lender market, the likelihood of you getting even 50% leverage, you're probably not going to get there. So it all has to kind of reset itself. We've had a very strong debt service coverage in the portfolio in general, but lenders are kind of looking at their constraints at the debt service base. So it's kind of the whole GFC playbook from when it's come back. We're targeted on higher debt yields, higher debt service coverage, and that's the constraint on how much debt you can get in your portfolio. So fortunately, the deals that we're in the market today on within that maturity bucket, we think we're able to get to replace that loan without having to put any additional equity in. So we feel like we have a good cushion partially due to how we looked at valuations.
So what have the floating rate, what's the typical floating rate cost right now? I mean, credit, assuming good credit quality, reasonable.
Yeah, you're probably in the 170 to 200 basis points over LIBOR. That's the problem with LIBOR is it's 1.5 or quarter.
Just got
So
I mean, the book here is showing about 6% on your floating rate now. I know this is.
as of the end of the year.
Correct.
Yep.
And I think one other point to point out is this is still slightly lower, I think, Ross, right, than the Odyssey.
Yeah, great point. So we ended the year at 3.92%, just total average cost of debt capital. That's about 25 basis points lower than that in the benchmark. So probably goes back to a lot of having that in-house group in order to really evaluate what the best pricing in the market is.
And as you pointed out, I mean, the balance sheet, you got to make sure that the liability side of this is just as important as the asset side, especially in environments like this. So that's where I think this is, proven the track record you'll see through the GFC managed it well, and didn't have issues. We want to make sure that's not usually as much of a topic, but given volatility right now, obviously it is.
The properties you're developing, do they convert at completion? Like, I'm familiar with construction loans.
I'm sorry, I didn't hear the start of it.
When the properties are completed, the ones you're developing, do they convert to a different loan?
To a fixed rate loan or something like that. We don't have any of that yet.
So once we take it, it stays. It's not like when I get a construction loan built. Okay.
Yep. We generally have extension options in those. So if something were delayed or still the lease up COVID, we have extension options built in that we can utilize so that we're not forced to have to go back to the market at an inopportune time. But we don't have any of the ones that kind of convert to a permanent loan at the end.
Thank you.
Yeah, so if we flip on then to slide 18, we just provided a nominal return performance. So I'm actually going to flip to slide 19. It's the same data we've just shown it relative to the benchmark, so I think it's a little more informative there. Our total return performance in the bars here is in the royal blue. We've shown it relative to both measures of our benchmark. You'll notice the short-term underperformance for the account kind of in those near to 1, 3, and 5 areas. It's not something we're used to having to come and report on. It's not something we're accustomed to by any means. We've seen just extremely disparate performance across our peers in the benchmark, particularly over the last 1 year period, where on 1 year total return across the benchmark from the best performing manager to the worst performing manager was 1,900 basis points different, which is the widest we've ever seen. So the best performing manager recording a total return of a little over 16% and the worst down a little worse than a -2% return. That disparity is just something we've never seen, and it goes back to how people are really recognizing the change in the environment from the latter half of 2022. We're not saying that we're 100% right and we know everything by any means necessary, but we certainly don't think 16.5% total return in 2022 makes a whole lot of sense either. We were an early mover in how we were impounding those valuations starting in the latter half of the second quarter as rates really started to rise and we started hearing more about debt lenders in the space, that capital was becoming more scarce and how that was going to impact future acquisitions and what that liquidity might look like going forward. If you look at fourth quarter 2022 transaction pipeline or activity relative to fourth quarter 2021, it was a drop off of over 75% depending on the sources you look at. So how that debt pricing happened really impacted how transactions were getting done and what that price was looking like. Just example wise, if you look at our office portfolio from really the start of COVID, when office was hit with the whole work from home transition and trend, we've written down our office portfolio a little over 22%. When you look at the benchmark, they've only impounded 10% right down. So there's clearly a discrepancy there in how that impacted where they're looking at.
And that's the major markets that they're overweight as well. So
Which anticipates my next question following around. But so the construction of the Odyssey Index, indexes, how realistic, or, I mean, you guys deal with the world, is that index, it's legitimate because of people use, but I mean, is it constructed rationally in your opinion, or is it providing distortion? You just mentioned if they've only knocked down to 10% valuation, and you've knocked down to 23?
Yeah.
Okay, so call me crazy, that seems to me someone isn't paying attention at the index construction level. So I'm just curious, not holding to you, but I'd love your professional opinion.
Yeah, I don't want to speak to the rationality of our peers there. You guys might have more insight to that too. A lot of it could come back to just valuation policies. So we have a very robust policy to really impound, because of our data valuation process, to really impound what we feel is reflective of value today. Some of our peers may have a different valuation policy, one that more focuses on a third-party appraisal as the final end-all be-all. We've heard some anecdotal evidence of some managers looking as they got appraisals, and appraisals have lagged. There's no transactions for them to look at. You've even seen some appraisals come in writing assets up, and we're like, that just doesn't make sense today. You can't get debt. Appraisals generally don't focus on the debt market. They provide you kind of a gross valuation, so it's a little different. We've just been more aggressive in how we look at the world today, and that's been informed by what our acquisitions team has seen in the market and deals that we would have bid on, and how those actually transacted, whether they were 10 or 15% different than what they went to market at. So
So the 10%, was that for office or the overall conversion?
just for office. Yep.
Do
And we have those
Do you
cuts.
have a slide that shows what you've marked down in certain areas?
We don't have it in here. We can certainly send it to you guys. I mean, we have data all over the.
I would tell you to send it.
Sure.
Yeah, I'd like that. Absolutely.
Yeah, we can provide all that. We have it cut up since COVID, just given the world certainly changed at that point, and then we also have it for 2021, just given, or for 2022.
At least from my standpoint, I appreciate transparency. It's bad news, you want transparency.
Yeah, you guys are investors, so it's your data, so you actually just know.
yeah, and one other point I'd mention, I think Megan Phillips, who I think you guys have met at one other point, who's one of the co-portfolio managers on the platform, is also on the board of NCREF, just kind of ahead of the Odyssey. So she has a unique perspective on this, but also I think would share the same of Ross's perspective, that some of this you will see as long-term performance that we're quite proud of, that this will normalize in the future, we think, and that's where folks are behind the curve, if you will. So, like we said, transparency is important, but also making sure it's as realistic as possible, because we are one of the unique once we do David evaluation, which in this space is somewhat rare.
I'd be curious to get your guys' opinion if that's kind of what you're seeing, additional catch-up here or there.
Yes, I do think there are some managers, and again, you probably know this, but the Odyssey, when you're comparing equities to the S&P 500, you have a static benchmark, public market securities that are blended together. The Odyssey is 26
Yep.
core products, and you're taking essentially a weighted average of the individual managers, blending them together to create a benchmark. So you can't replicate the benchmark. It's not like an index fund that you could buy. It is just a weighted average of the 26 participant or, managers that have constructed their portfolio within certain parameters to qualify into that.
Yep.
that benchmark.
And that shifted too, so there's a little bit of flexibility in that as well. So.
Right.
Yeah, and then finally, just at the bottom of this slide, we provided our income returns, kind of that blue header table, and we outperformed the benchmark over all time periods shown there, and that's something we really focus on, and goes back to that income growth I talked about earlier in the deck. And I only mention this just because going forward, as values have reset and things continue to be volatile, we think that income component of total return is going to be a much larger driver of that total return, where in the past, appreciation has been a massive component of that. So we'll look to continue to maintain that overweight. We think that puts us in a good position going forward. And on slide 20, actually, we talked about our same property NOI growth, giving some opportunities to maintain that outperformance. But here on the slide, in the gray bars on the left, this is our actual performance, historical actuals on a calendar year basis. And so over the last 10 years, we've had strong performance, averaging almost twice that of the benchmark within the same store NOI. Actually, 2022 had a very strong year at 15.5% growth there, and that's the highest recorded for the account since we've been tracking that metric. As we look forward in the kind of the blue box here on the right, that's our forecasted NOI growth through 2025. In 23, you'll see that 2%, that kind of lower amount shown there, and that's a function of a couple things. One being having such a strong year in 2022 where we pulled forward some growth. It's very hard to kind of incrementally have a large number after that strong year, but it's also a function of kind of impounding our house view that there's a higher probability of a recession impacting 2023. So we've impounded that into our cash flows and our valuations, reducing kind of that rent growth potential for the year, and then not having any real speculative lease up starting during the year at all. And then in 24 and 25, we have some opportunities to continue that growth. Our highest or kind of organic opportunity in the portfolio today is in the industrial sector. The average in-place rents today with our portfolio are about 25% below market for the prevailing market rents today. So normally, as you think of like tenant rollover, as those expires come up, that's normally a bad thing. What are you going to do? Actually, industrial, we think it's a very large opportunity today to really right-size and capture that delta today between the contract and the market rent. We've really seen that historically. We had a deal in Dallas, Texas, with a single tenant, 370,000 square foot tenant that told us they were going to vacate. We had a tenant come in and backfill that with no downtime, no free rent, and they paid us 60% more than the prior tenant was paying in the space. So it's a real opportunity within industrial. The other side of that coin is just speculative leasing for spaces that are currently vacant in the portfolio today, primarily in the office space. We have some opportunities there to start leasing. We think we've been really cautious and prudent about how we've pushed out that speculative lease up within our forecast. On average, you're seeing this lease up space that's vacant over about 3 to 5 years in our cash flows. You're seeing a large contribution to that kind of dollar growth here in office just because those generally are your highest rents in the portfolio. So being able to put, any rent to work in a space that's actually really negative NOI to us because you got to keep the lights on and everything else. So that's that large contribution there. But I do want to point out that it's not like we're leasing up our entire office portfolio and saying we're at 100% by that 2025 period there. Then on 21, we've just taken the same data as that last slide. We've just kind of spliced it slightly differently. So we've shown it on cumulative dollar growth on the left-hand portion, but then on the right-hand side, we've broken out where's that growth coming from. And you'll see we have a majority of it coming from that core of the operating portfolio, which is great. And then we have kind of supplementing it by the deals that were in development or in lease up today. So we have kind of diversification of that income And then, yeah, finally, the last slide is just kind of a summary of basically all the talking points that we touched on here. So happy to answer any additional questions you guys have.
I have a question about the residential side. Obviously, you mentioned recession a few times, and I think that's on everybody's mind. I keep watching this employment number, though, and trying to figure out how we're going to go into a recession. But what have you seen on the residential side as far as rents not getting paid or people asking for, reduced rents? I mean, across the whole portfolio.
Yeah, so that's generally gone away across the majority of the portfolio. California assets being the one outlier just because of the mandates there for eviction processes. They keep kicking that can when you can't do anything about it. We had one deal in Las Vegas where we had some collection issues there. We shored all that up. So for the most part, we had kind of cleaned up that process for collections there. As far as last year, probably start of 2022, we were seeing trade outs as tenants rolled or came up for renewal in the double digits there, and sometimes even higher. The latter half of the year, we just had our quarterly meetings where we go through the entire portfolio and talk to our asset managers about exactly what they're seeing on the ground. That's slowed down slightly on the back end, where you're seeing maybe higher end single digits, sometimes in that 5-4% range. So that trend is coming down, but still growing. But overall, we think residential is a great positioning from a defensive nature, just in case for those recessions, just given the rents are only, or the leases are only a year. So if the market pulls back and rents go down, as the market comes back up, you can get to those leases a lot faster. So we think that's a good positioning in the event of a recession.
Any more questions for anybody?
What's your take on the valuation cycle, kind of internally, some of the other portfolio managers that we've been speaking to saying, the quarter that we're in is probably looking like another -6, -7, second quarter, best guess, down another 2 or 3, and then maybe third quarter, we kind of have bottomed out and positive. I know things can change between now and then, but just kind of given where we are, what's your expectation for that valuation cycle?
I think the numbers you've mentioned are consistent with what we're probably thinking or seeing. Hopefully we're starting to get to the point where we've impounded more of these write-downs than our peers, so hopefully we start to see some of that spread perform on a less negative basis, I guess, going forward. Consistent with what I talked about in the withdrawal queue, just where we think the world was and where it is today, given the last 2 weeks of volatility, that might have changed. I think the bank failures and what that's going to do to the market is going to probably constrict credit a little more. We've already talked to a lot of our banking groups, even our internal private debt side said they've taken a pause for a minute. So that's not going to help the market, certainly for a bit, as everyone absorbs that. So whether that all kind of normalizes and people kind of realize that the cost of that debt capital is going to be higher for longer, if that means that this keeps going through the third quarter, it's hard to tell at this point. I think everyone's kind of still figuring that piece out, but I think that consensus that you mentioned is pretty close.
Yeah, that's realistic. I think that what for the income component is so important. I think that had been out of whack for a while, whereas appreciation forever is going to be, if we can get back to high single digits average, that's the idea.
Yeah, that income piece is something we've watched very closely. And normally on a quarterly basis, the general is 1% income on a quarterly basis, 4% a year. We've seen that really come back, and a lot of that was driven by valuations got so aggressive, so it's trending closer to maybe 90 basis points every quarter we saw. This last quarter, we saw some of our peers reporting, 65 basis point income returns. So whether that's not right-sizing the values or they just had more floating rate debt or expensive debt, it's hard to really bifurcate what's driving that, but we've seen a serious decline in that income piece across the benchmark. So it's something we're focused on maintaining and right-sizing for us.
Do you foresee that cash that you're holding, that whatever it was, 500 million or something, being used to buy some of the debt that you have that's rolling over?
Are you talking about the contribution Q balance?
Correct.
Likely not going to use that to pay down debt. Most likely use for that is once we feel like valuations have kind of settled down, it'd be probably to use that capital to potentially pay out part of the withdrawal queue, and partly for hopefully new acquisitions, but we'll evaluate kind of what's the best for all investors at that time. Because certainly right now, utilizing any additional debt to do any of those payouts is just not accretive to the portfolio. But
For the last question, no exposure to Silicon Valley or any of the troubled banks within the portfolio?
Banking wise, the only exposure we have is very small, and it's about $2 million of letters of credit with tenants that we have. So really, it's not, the tenant would have to not perform on the lease for us to even have to call them that letter of credit. So we don't have any banking relationships or direct exposure to them at all, or any of the things that have been in the news lately with many of those issues.
So if run up to 100 basis points per quarter, that's 4% a year. How are these people showing like 8% returns? Is there not adjusting their valuations, or still raising when they should
Bingo,
have?
all in the appreciation side. And that's what we tried to wrap our head around as well.
This doesn't make sense.
No, and it's gonna catch up, you'll see.
It
Again,
doesn't
that's-
compute, basically.
If you go back, like, and you might have some data on this too, going back to the GFC, that's where you saw people were not writing down things appropriately, if you will, and it does catch up at some juncture. When is a different question.
I appreciate you guys being ahead of the curve.
And if you had, I mean, if your portfolio was 8 or 10% overweight to industrial, you could carry some of the returns from early '22 through the end of the year and still look good. But now as you're getting into '23, industrial's starting to come down as well. Office was kind of first, office and retail, but the other parts that are getting hit too. So to the extent that you had overweights to those outperforming areas, that again just
So
kind of
accounting
factors in.
explains it.
Yeah, and they massively outperformed, like you mentioned, so for a while, there's some industrial appreciation that was through the roof. Unrealistic, I'd say, as well, or like long-term, it's just kind of hard.
If you looked within the you were talking about the spectrum of the Odyssey managers last year, and it was a function of industrial first and residential second. The more you were overweight those two areas and underweight office and retail, you did better. To the extent that you were more neutral or even overweight those other areas, you were at the bottom end of the spectrum. But again, and because early in the year or even through the end of the year, they weren't facing any write-downs. They're starting to face those write-downs now. So you're subject to overweights in the areas that are now being written down.
And you mentioned the benchmark earlier, there were also some new core funds that came in that had no office exposure, that also just did industrial multifamily, and that's, I would say, a little short-sighted, because of your point, there's gonna be a point where, there's some relative value in something or another, but they were added to the benchmark, so you have this kind of outlier of funds that are newer, that don't have any traditional office exposure, which is unique in and of itself.
Our police and fire pension, they have we have the income segment, which includes all credit, and we also have more real estate in that plan. And we had been looking at an industrial focused closed-end real estate fund last year. It returned over 50% before we could get into it.
Prologis or something, I'm guessing.
Yeah, and the flip side of the industrials, the valuations got so aggressive on those. In some markets, we're seeing cap rates sub 3%.
Yeah.
So
Just
as
collapse.
things have changed, those are the most sensitive to these valuation impacts when you got to get back to. We've heard buyers say, I gotta have the ability to get to those market rents you're telling me about in the first about 4 to 5 years, because my lenders tell me my cost of capital is so high that I'm not willing to carry a negative leverage position. So we've written our industrial, I think we only had 6% appreciation last year as we did write-downs, and the index was still above 12. So we've kind of taken all that feedback from the market that says, it's great, we believe in industrial, but at the same time, buyers are telling us, like, I just can't wrap my head around this because of the debt side of the story. So it's,
Well, Jim, thank you very much.
Yeah, thank you.
Would you
Thank you all.
listen to your card, please?
Sure.
I'd like if you-
It's in the
Okay.
hotel.
I'll
I'll send it to you.
That'd be great.
Yeah.
Okay.
But Pat has something.
Hey, John,
Yeah, Pat.
John, can I ask a question? Yeah. Experience, or if there is any, of these private equity kinds of accounts converting to public companies. Has that been happening, or does it happen?
Private real estate, you mean, going to REITs?
Yeah, converting to a REIT or something of that sort, looking to arbitrage possibly into the public market.
Right now, I haven't heard of it recently. I don't know if you guys have heard any of that. Most of what we've heard has been a REIT going back private, probably. But I haven't heard anything recently there.
I mean, I think selling pieces of a portfolio to a REIT, but not a whole conversion, just because the mismatch in the public pricing and the private pricing.
And Pat, are you asking are you asking the question kind of based on a pricing arbitrage, that if you could get out of a private market real estate portfolio before the write-downs occur and move the money over into public market, which has already taken the 20% or so decline last year? Is that what you're asking?
Yeah, that's kind of it. You know, are there market opportunities at some point where, you know, public real estate is priced better than the private markets? I mean, there are advantages to public real estate in terms of liquidity and mark-to-market and things like that, but does it ever happen?
I'll give you my take on it. I think the answer generally is no, and it's because when there are big dispersions between public and private real estate, it's usually the public that goes first. It writes down. At that point, all your private stuff has a queue. You can't get out. If you could get it out at that point, then maybe you could jump from the private, which is still hanging on to the elevated valuation, and jump into public. But you know, this has happened 2 times in the last 20 years. First one was 08 into 09. All the funds had an exit queue, and then here we are today. Everyone's got an exit queue. So you don't have the liquidity on the private side currently to be able to jump from one to the other.
Yeah, the same with private equity and traditional equity, the same right now.
Yes.
Yeah. So yes, it's the illiquidity premium that traditionally why you are in illiquids is there is a mismatch for a while. You're correct, but yeah, you can't trade. Just technically difficult.
Very good. Any more questions before we go on?
And we'll send you guys the information on
That'd be great.
the office
Thank you.
breakdown.
Yeah, thank you.
Thank you all again for the time. Really appreciate it.
Thank you.
Business, yeah. Have a great day.
Great, thank you very much. Safe travels. All right. Andy, you are next on the hit parade here.
Morning.
All right.
Well, the good is on a relative basis, the portfolio continued to perform very well. So we've got the 228 flash in front of you. Got the asset allocation on the first page, and you can see, you know, again, through February, we're at 591, and that was a decline from 605 in the month of January. So again, first few weeks of February, the market was positive, and then as kind of the sentiment rolled over, again, think back, fourth quarter through January, we were beginning to think the Fed was closer to ending the interest rate increase cycle. And then some of the inflation numbers in the middle part of February came out and said, no, we probably have a little bit farther to go here. Inflation was staying elevated. Maybe there's going to be some further increases. And so we saw some volatility, especially in the last half of February into the first few weeks of March. Now again, staying on the sort of roller coaster theme, now that is beginning to swing back the other way because of the bank failures in that discussion. You know, now that maybe that's putting a bit more pressure on the Fed to say, hey, we're going to have to slow down a little bit faster. They just announced a quarter point yesterday and remove the language kind of indicating future increases. So again, that's kind of getting back to the optimism that the Fed is closer to ending than maybe that was thought just a few weeks ago. So kind of
You
again,
said the speech, I thought the speech was a little different, that they were going to continue a little longer.
I think
Of course,
that was sort of the
no.
tone of it, but then in sort of the release of the information, removing some of that language.
Yeah, they forecasted one more hike for the year. When, what, how much, who knows?
Right.
That's what it is.
But I think, you know, the worry was, as of kind of the end of February, that instead of 1 or 2 more, say, quarter points, that they were going to do another 50 and maybe 2 or 3 more quarters kind of through the summer or something like that. And now, again, it's sort of oscillating back and forth, but it seems like we're a little bit closer. Kind of, again, back to what we were thinking in January, is that maybe it's another a quarter, perhaps even 2 quarters.
If they go over 5, we're toast.
But again,
Oscillating describes the Fed.
Maybe toast.
well, yeah, I mean, it's possible. And again, over the course of 5 years from now, it doesn't matter whether they do 1 more quarter or not, and if it if it's a second one that's in June, or that's not going to make a tremendous difference. But certainly from a market sentiment perspective,
Is there an acceptable inflation rate other than 2%? Say 4?
I think it's going to be higher for a while. I mean, 4 to 5, I think.
I mean, I don't see them changing their stated goal. It's been in place too long, but I don't think
Is
they're.
it achievable without putting us in a deep recession?
not anytime soon.
Not unless people start not having jobs.
It'll take a few years to get there. You know, it's not, again, given the employment situation, given the labor markets, it's going to be elevated above that for a while. Page 3, again, I tend to skip over this a lot, but if you look on the left-hand side, so far calendar year to date, the portfolio is up about 5.5%. The benchmark is up 3.5%. So you can see quite a bit of value add relative to allocation effect as well as manager outperformance, added about 190 basis points on top of that. You can again see that total fund on the top of page 4, just as we kind of traditionally look at it. Fiscal year to date, 17.7%, which is absolutely phenomenal. Certainly, first, we're into March, so that has come down from there, but on a relative basis, absolute basis, really fantastic performance overall the total fund in this new fiscal year. And then again, as we move over to page 5, just to kind of touch on some of the individual components, Barrow, Hanley, and Value and Brown were behind for the month of February. Again, negative performance really across the board in all of the equity managers. But you see Pazina, DGI actually was positive 85 basis points versus a negative 99. So they had a very good month. Must have been what you said to them when they were here last time. When they worked.
Maybe they felt like their paycheck was on the line.
That's right. Silchester outperformed. Now there was a bit of a give back with Bailey Gifford. You see they were down 6.25 versus a negative 280. But interestingly, the 2-month number, they're still up 173 basis points. So it shows how well they did in January, and then obviously gave some of that back in the month of February. Fixed income, interestingly, Loomis, so down about 2.4%. That did outperform, as we saw again, as the market began to worry that the Fed was going to continue to raise more, rates shot back up. Then, of course, in the last couple of weeks, rates have really come back down again. So if we looked at that today, you're probably looking at a positive 3% sort of month to date because of that roller coaster in interest rates. But it's just kind of interesting to see how that is flowing back and forth. And then, of course, Principal, you just heard from, they actually mark on a monthly basis or daily basis, so they're at a 9 basis point positive. But you can see, obviously, the relative performance over the last year or so, they are a bit behind. And some of that is the more conservative nature of their portfolio in terms of how they how they're marking their assets, and certainly some of the.
If you look at that 1-year column, I mean, that's really something.
It is.
I didn't raise that issue while they were in the room, but there you are.
Yeah, and again, because these are private assets, they're not the values aren't being set by the market, traded daily. You tend to have more skews in a short-term nature.
Is it
Negative
realistic?
7's negative 7. I don't know.
Is it realistic to think?
Fiscal year or 1 year?
1 year.
That's the 1 year.
Got it. In a couple of years, that will be flipped the other way? I mean, is that our thought
It's
process?
certainly the expectation, because again, now, this is of course on the assumption that their thesis is correct. That you continue to see write-downs in some of the industrial and office space that they've already taken. So their peers, they come in with a negative 5%, well, they come in with a negative 1% because they've already taken the write-down.
Sure.
Where some of these other managers haven't. And again, we've always viewed Principal kind of very conservative, not only in how they allocate funds, but also how they appraise or how they value their portfolio. That tends to be how you see, on the way down, they're going to tend to lead their peers. And then when things turn back around, they will tend to do better because, again, they've already taken the write-downs and they can start to write things up again as the market turns, where some of their peers are still kind of waiting to take those write-downs, and it takes them a few extra quarters to kind of turn the corner, so to speak.
Put a tickler on that and look at it in 2 years, just to see if it was
Sure.
We look at it every month.
right.
Yeah, are they monthly or daily, you said?
Well, they actually value daily.
Okay.
But we look at performance
On a
on a
monthly
monthly
Correct,
basis.
we're getting the flash report.
I draw, from a strategic standpoint, we used the real estate years ago as a proxy for bonds. We were worried about low interest rates. And we realized you're picking up more risk in commercial real estate with leverage and then bonds. But if you look at the 3-year returns for Loomis, 3-year, 5-year, and then the 3- and 5-year returns for Principal, despite last year, which, obviously, I would say our strategic decision was the correct one, up until right now, just looking at the performance. So,
Now the question becomes, you kind of raised this previously, now that you're collecting a 4+% coupon in fixed income, and you're getting essentially a 4% yield in real estate with some of the valuation risk,
Yep.
there's not quite as much of that, quite as much optimism favoring real estate, at least core real estate, as compared to what it was, say, 5 years ago.
that strategic trade worked. I question whether we're gonna repeat the last 3 to 5 years. Do I think that they're, for what they do, are they conservative? Yeah, the question is, but on a strategic level, we took a bit of a non-conventional decision to avoid what we thought was accruing.
Okay, follow that along, so what do you suggest?
I'm thinking we need to consider, my assessment is looking at some additional bond alternatives in lieu of the risk, or in addition to, but I don't know how we slice it. This is a staff decision, but it seems pretty clear to me that we're now finally, after a decade, getting reasonable returns on bonds relative 5 years ago. I think that was going to be the case.
And, we put in last year for a redemption,
Yeah.
but, they'd been locked up since June.
Sure.
And we put in.
Is that 16 million that we
The
have in the
16
queue?
million, so, which is what I asked them about, because, it's fair for them. They want, they've got fiduciary responsibility to both buyers and sellers. So, they would like a more stable market where valuations have sort of sorted themselves out and, are more stable, to allow the queues to flow in and out. And, I understand that, but they can't give us a time frame. The idea was, with that 16 million to potentially go into fixed income or some other, whether it's core fixed income or some other type of fixed income type product or credit product. The alternative is to take money from equity managers, and, we weren't really considering that at the end of 22 because of the performance of the equities. We didn't want to sell at the bottom. You've seen some outperformance. They've come back quite a bit, but the question is, do you want to shift assets from equity managers into fixed income? A lot depends on what goes on with the economy, with the recession, and whether we go in, whether it's a soft or hard landing type recession, or some people still think you can avoid it altogether. I don't know that I buy that, but so I think we're kind of in a holding pattern at the moment to see when we'll get the money from real estate. And then, if at some point, the Fed's still raising rates, and at some point they're not gonna talk about lowering rates unless they see us tipping into a recession. And at that point, you'd like to try to get ahead of that if you're going to allocate to fixed income. So maybe you can take advantage of rates going lower, but we just kind of play it by ear, see when we get the real estate. At some point, we could decide to take money from equities to put into fixed income.
I have two thoughts. One, we've used the stabilized real estate as a bond proxy. That's been our thinking strategically. Certainly, we could change our thinking and shift that, put that more in the equity bucket. It would be one way to try and change, and then perhaps take some funds from equities to some attractive bond alternatives for a reason you stated, which makes sense. I think the other issue we need to be cognizant of is that the city of Gainesville appears to be heading towards some fiscal challenges. And I think the funding costs to the pension plan, if we go into a deeper recession than people are thinking and equity prices go down and there's got to be additional funding, look, it's not our job to manage the budget of the city, but I think that we need to be cognizant that there's upcoming stress. And to my mind, if it was a household, and I said, hey, we think you might be, one of your spouses is going to lose their job and income's going to drop a lot from your household, probably ought to raise some liquidity to get us through to protect. So again, I don't want to be a market timer, but I'm inclined to take some risk off the table. Since lower risk assets, we're finally getting paid way below our assumption rate, but we're getting paid reasonable. And so I think that's another consideration that we ought to throw into the mix, is my personal assessment.
Well, Did they have any good ideas when you met with them yesterday on alt credits?
Yeah, we're gonna have both Anco and Willis Towers Watson do a deeper dive into it. I only received the material the day before, and so along the lines of alternatives to core fixed income, principal, we had a discussion with them yesterday about a private credit, private debt type fund that they've set up. It's closed in with about a 7-year time horizon, and it's already established. They have a 3-year record, but they're bringing it out now sort of to see what the interest is, with an idea that, you know, they've got a return range of say 12%. And basically they're making loans to private equity companies. And they've already got some deals. It's kind of, you know, there are like vintage pieces that they've sort of accumulated over the past 3 years, and they're wrapping it into a fund product where you can buy into it all at once. Well, not all at once, but kind of front loaded, say 70% of your capital would be called immediately. And so those are the kind of things. We have this sort of segment on the police and fire pension plan that Willis Towers Watson has put together, but it hasn't performed like it sounds like this product would. We've got, on that plan, we've got a company called One Sharp that does home renovation loans that are like a year in maturity. They claim they'll return us 6%, which, you know, to me, it's like, why are you guaranteeing you're not going to earn your assumption rate?
Right.
But they actually return about 5%, and it's not very transparent, and it's not liquid at all. And we have some high yield debt, you know, Ares and Bank of New York Mellon, Fallen Angels Fund, which, you know, are high. To me, they're more highly correlated to equities than fixed income, and they're locked up as well. So, and Libermax does mortgage backs and asset back and commercial mortgage back stuff. And, you know, they've done okay, but, you know, as soon as we got into them 2 years ago, they had a negative 40% month, which to me means Willis Towers Watson doesn't really fully understand the risk involved. But
Surprise!
staff has less influence on that board because it's its own board of trustees, and there are union representatives, and they mistrust staff, so they do whatever that consultant tells them. And we have some friction there, but anyway, you see how we've got some of the allocation done in that plan. It wouldn't hurt for us to consider that type of investment, but with you know, more clarity and a little more evaluation.
I think we should proceed that. I mean, the alt debt, distressed debt, however you want to phrase it. I mean, clearly the key there is you better do your credit quality really good. And I think principal, is my assessment, does their credit quality well. So otherwise you get your ass kicked real quickly in those areas. But if we're going to a stressful environment, again, it's Baron von Rothschild, you know, cabled, I think it's French compatriots during the French Revolution, you know, buy when there's blood in the streets. If blood's coming, we may want some skilled managers that know how to extract good assets at deeply depressed prices. And I think that area makes sense strategically, and you know, we can talk, but I actually want to take some action. I think the action is, let's tee up some options. And I think de-risking to some portion, and to my one person on the board's recommendation would be we start going down that path. We are a slow-moving animal, but I think that for all the reasons we discussed already, I think that probably makes some sense.
Well, my take on it, John, is like, they all promise that 8 to 12% returns, the alt credits, and they're averaging maybe 2, and you're paying anywhere from 75 to 125 basis points for this right to do this. And my other problem with it is all the benchmarks, except for One Sharp and another one, are made up. There's no benchmark to compare it to. There's no, honestly, like if you're the LIBOR plus 1%, you got a benchmark.
That is one of the challenges when you get into some of the
Oh
alternative
yeah, they all promise you
strategies.
12%.
Yeah,
But once you're locked in for 5 or 7 years and you don't perform, you're locked in.
correct. Or you're looking at taking a 50% haircut if you sell on the secondary market.
So anyway, I think you're rolling 6-month treasury bills, or you're doing some more alternate strategy. I still think that finally, after a decade, there are some attractive yields for lower risk assets that are over allocation to equities, which is served the plan well long run. But, you know, I think it's time to reevaluate our allocation for assessment.
Well, we could have for the last couple of times, we've been more focused on the real estate part of the discussion, but we can broaden that out and include, some of the different debt parts of the market, whether it be public and private, floating rates, some other things like that, and then just make it a more holistic discussion.
We should do that, yes.
I mean, the real estate is 5.3% of the current allocation. I mean, it's not insignificant, but they're strategically, but there's bigger leverage points that we can do to either protect or drive return.
And you've already pushed the button to cut it in half.
Right.
You're just waiting on it.
Right. So the answer is, I think strategically, I think the bonds piece probably need to start exploring that more seriously. So if you can,
Absolutely.
if that's okay with staff, does that make something you're already on that page?
Yeah, you're probably already down that road.
A little bit, but no, I mean, we say we don't want to try to be market timers, but we do like to try to anticipate cycles. And if you think that a recession is coming at some point this year, then it makes sense to maybe try to tweak the portfolio. And the question becomes, well, you do that, but then when do you decide to move back? And so there are two decisions points for every kind of reallocation that you want to do based on market cycles. But I agree, it's worth looking at, and certainly maybe shifting to value, even on the equity side, and doing that through the sort of subtle mechanisms we already have in place when we do quarterly withdrawals and things like that. How we source those.
That's a method of reallocation, of course.
Yeah.
Okay, very good.
That is everything that I have for you, unless there are other questions.
Any public comments, questions? All right, great. Well, then I'd entertain a motion to, before we go, parking, really, I mentioned to you, and I don't know if anyone else had, I had a nice little notice from the city saying that we're not going to find you right now, but, your tag and pass is no
We
good.
think we've got that resolved.
You do, okay.
In the past,
When do we get out?
we had
As long as I don't have a boot on my car.
in the past, we had to go through the Human Resources Department to update the city's parking system. It's automated now.
Right.
We've gotten control for you guys, so we're doing that internally in the finance department now, and it should be up to date.
Good.
So, but by all means, let me know if you get a notice or a ticket, and we'll deal with it.
Fair enough. All right, thank you, Mike. All right, motion to close the meeting. Second? All right, meeting closed. Thank you, gentlemen.